Of the handful of financial fortune tellers who predicted the crisis, perhaps no one nailed the fallout better than value investor Whitney Tilson of T2 Partners. And before everyone else, he told you to start betting against the financials right here on Fast Money.
We're short across the financial sector. We're still short the bond insurers. We're short the mortgage insurers, PMI and Radian. We're short, we've reshorted Lehman, for example. We've reshorted Bear down here. So we think there are a lot more shoes to drop.
That was Tilson almost exactly 1 year ago. The stocks he said to short reduced to pennies or driven down to zero. This value seeker even out-traded the most legendary value investor of all time, Warren Buffett, whose Berkshire Hathaway is now considered to be more at risk of default than the debt of Vietnam. But it wasn't just the trade that Tilson got right. It was the political prescription as well.
I think ultimately Congress is going to have to come in and do some sort of multi-hundred-billion-dollar program to try and help the homeowners learn about the third inning of the great unwinding of this bubble.
Now the prophet returns to tell us if this terrible game is over or if the recent rally is just the seventh inning stretch. With us now to trade tomorrow, the prophet himself, Whitney Tilson of T2 Partners. And I hope that running that glowing tape doesn't mean that it's the top for you.
Right, you know where to go but down from there.
You made a fantastic call on Lehman Brothers as well as Bear Stearns when you were on Fast Money back in March last year. What's the call on financials at this point?
Well, it's sort of mixed at this point. Valuations have compressed so much that some things we were actually short, we flipped around and went long, Wells Fargo being the most noteworthy example. We're also long American Express. We're looking for sort of, to the extent we're bottom fishing in financials and we think there are a lot more losses to come, we're looking for companies with strong balance sheets, real franchises that we think can survive and aren't going to have to do highly dilutive equity raises or get bailed out by the government. And you know, there are no certainties here, but Wells Fargo, for example, we think there's sort of a 70% chance that they make it without any, catastrophic outcome, in which case it's a $40 to $60 stock, and if they don't make it, it's a $2 stock, and at $10, $12, $15, that's a pretty attractive risk reward.
Does the toxic asset plan, the TARP money, does all that play into whether or not you decide in buying a financial at this point? Well, is that a major factor?
Generally, there are 5 or 6 or 7, I've lost count, a dozen government programs that are just injecting large amounts of liquidity into the financial system, trying to sort of stave off Armageddon. Generally, I think that's the right thing to do. The financial system, this is the lifeblood of our economy. And it's sort of working. It has staved off Armageddon here. And so I think, companies like American Express were long in part because they are able to access some of those programs and stay, keep the business going.
Have we gotten to the point where a fundamental guy like you can actually value these things? I mean, it seems like everyone everywhere is raining cash upon them, which makes it relatively difficult to actually come up with a valuation and come up with a valuation once that spigot gets turned off.
Right. Well, we're not going into the more speculative stuff. So we're looking, we think we can value Wells Fargo, American Express.
What kind of loss provisions do you have in American Express with their, I don't know, close to 7 now? Where do you think that?
We assume it gets up to 10 or 11%. And the thing to keep in mind is you want to be investing in companies that are making a ton of money right now. And this is where the analysis we find is often wrong, where people look at what the losses will ultimately be, and then they compare it to today's balance sheet or today's reserves. And if the losses are higher than the current reserves, they assume that the company is toast and the stock is toast.
But I know Wells spreads
what they're missing is
now.
Exactly, like Wells Fargo. We just wrote a chapter on Wells Fargo for a book we've got coming out in a couple months. And the analysis is that Wells Fargo is going to see somewhere between 50 and 120 billion of losses. They currently have 20 billion of reserves. So why on earth would we be long that stock? And the answer is those losses are going to come in over many years. And we think they're going to have, let's say, 8 billion of losses per quarter for the next couple of years at least. Huge losses. The thing is they're making 8 to 10 billion of profit per quarter. And as long as their profits are keeping up with those losses, they're going to win that race, and the stock's going to be at 40 or 60 bucks in 3 to 5 years.
And the chairman referred to TARP as asinine, and he did so in public, which is reason enough to buy the stock.
I'm not sure that was very prudent of him.
Apparently a pretty sharp-dressed guy, as the video attests to. Listen, hyperinflation, is there any chance we avoid it? Can they get out of this elegantly, or are we headed down that street?
Well, I think we're not sort of macro prognosticators. Right now, I think with the world economy just collapsing, basically, and that hasn't changed in the past couple of weeks, equity rally notwithstanding, that the bigger concern is deflation. I think sort of once we get through and the economy maybe starts to stabilize, we're thinking maybe a year from now it bottoms. We're still a ways off from the bottom. At that point, you start to worry about the inflationary scenario. But today, I think the concern is almost the opposite.
All right, Whitney, going to leave it there. Whitney Tilson, thanks so much. Whitney, the prophet Tilson of T2 Partners. Trade number 2.